We are zeroing in on a stable fundamental state based purely on operational data and its strategic trajectory. Let's get right into it.
Part 1. The SOTP Valuation Puzzle. To really understand the RUBYMILLS Limited, or RML, you've got to apply a bifurcated lens. We're looking at a classic sum-of-the-parts entity within the Indian small-cap equity space. It's almost like a giant puzzle. On one side of this valuation battleground, you have the holding company value. This is the domain of the conservative book value purists, right? The folks who are laser-focused on the underlying real estate. Then on the flip side, you have operational growth, which is tracked relentlessly by aggressive growth hunters chasing yield in the textile sector. So investors are constantly weighing this hidden intrinsic value of the land against the cyclicality of textiles. It's a perpetual tug-of-war in market sentiment.
Part 2. The dual strategic moat.
Okay, to properly value this entity, we really have to deconstruct its bifurcated business model. As of May 2026, the company operates on two very distinct pillars. On one hand, you've got the steady-state textile processing business. Management has deliberately pivoted this toward an asset-light expansion model to service high-end institutional and retail clients. But operating right alongside that is a high-yield commercial real estate portfolio. And this real estate division is absolutely crucial. It acts as a highly defensive cash flow buffer with a strict focus on maximizing yield. Essentially, one engine provides the operational cash flow, while the other provides this bedrock margin of safety.
Now, when we talk about that bedrock, we're specifically looking at the Ruby in Dadar. This is undeniably the company's trophy asset. The data here is actually pretty compelling. The property has maintained near 100% occupancy, generating literally crores in defensive cash flow. Plus, it's currently riding a 15% compound annual growth rate in Mumbai commercial rental yields that we've observed over the last 24 months. Now, in a strict equity analysis context, this commercial space does a lot more than just generate revenue. It provides a critical margin of safety against the inherent volatility of the textile sector.
Part 3. Operational milestones and the journey to debt-free.
Let's walk through this timeline because it gives us a really clear view of their strategic execution. Back in FY22, the immediate focus was pure post-pandemic recovery, restoring those disrupted supply chains and clearing out inventory. Moving into FY23, we see a really critical consolidation move. The company actively deployed its real estate cash flows to significantly pare down long-term debt. Then, by FY24, the focus shifted to margin expansion. They pushed a premiumization drive, specifically through specialized interlinings, which actually achieved a solid 12% top-line growth in textile revenue. Fast forward to FY25, and accelerated infrastructure, specifically the Metro 3 connectivity right in the Dadar-Parel corridor, drove a massive appreciation in their remaining Mumbai land bank valuations. And that brings us right to the culmination of this whole cycle in Q4 FY26.
And the culmination of this cycle is marked by this Q4 FY26 peak performance. The company officially achieved a net debt-free status as of March 2026. Guys, this is a massive structural milestone. It means this hybrid entity is now operating with a completely lean balance sheet. The debt-to-equity ratio has hit a 5-year low, which lays down an incredibly robust foundation for whatever strategic direction management decides to take next.
Part 4. The bull case catalysts.
So, having established those baseline fundamentals, we've got to evaluate the structural catalysts that could bridge the existing gap between the company's current market capitalization and the true intrinsic value of its real estate. The bulls argue that the immense hidden value of those central Mumbai assets just isn't fully priced in yet. So let's break down the specific components of this potential upside.
These are the three primary levers driving the bull case. First, that zero debt status we just talked about, well, that translates into immense dry powder. RML is now financially positioned for inorganic acquisitions or brownfield expansion without stretching its balance sheet one bit. Second, recent regulatory easing for mill land redevelopment in Maharashtra serves as a direct catalyst for monetizing their remaining land parcels. And third, really the ultimate prize for value investors here, is the potential re-rating of the stock. If the broader market begins to value RML based on its real estate assets rather than just its textile output, we could see a fundamental shift from a textile multiple to a significantly higher holding company multiple.
Part 5. Bear case anchor risks.
However, a thorough equity analysis demands strict neutrality, so we have to look at the other side. These are the heavy anchors currently constraining the stock's momentum. First off, skeptics point to stagnant top-line scalability in the core manufacturing division. You know, the textile business faces intense competition and really high domestic raw material costs. Because of this, there's a distinct vulnerability to sudden spikes in global cotton prices. On top of that, cheaper imports from free trade agreement or FTA regions constantly threaten to squeeze their already thin processing margins. Basically, the textile engine is steady, for sure, but it is not currently a high-growth compounding machine. And then there's this figure, staring right at us. 75%. This represents the promoter holding by the Shaw family. Now, while a high promoter holding definitely ensures management stability, it creates severe liquidity constraints in the open market. This lack of free float is a huge deterrent for large domestic institutional investors. It seriously limits institutional entry and exit, which often leads to sharp price movements on very, very low volumes. Additionally, the dreaded holding company discount often plagues stocks exactly like this, where the true real estate value never fully reflects in the share price simply because there are no clear immediate timelines for asset monetization.
Part 6. The 2026 Strategic Outlook.
Now, to counter those exact anchor risks we just walked through, management is building what they're calling the self-funding engine. They're explicitly pivoting away from commoditized markets and moving toward highly specialized B2B fabrics, things like premium shirting and technical interlinings. And to protect their margins from those FTA imports, they are aggressively pushing vertical integration and adopting digital supply chain technologies. The goal here is simple but absolutely vital. Ensure the textile engine generates enough cash to self-fund its own operational growth.
Which brings us to our ultimate strategic synthesis for 2026. Look, the RUBYMILLS Limited is a structurally sound, closely held hybrid entity. They are no longer simply waiting for a land deal to save the quarter. Actually, it's quite the opposite. Management is actively optimizing operational margins, targeting a very specific 10 to 15% revenue growth in textiles for FY27. By ensuring the textile division basically pays for itself, they successfully protect their real estate upside. And perhaps most importantly, management has confirmed there are zero immediate plans for equity dilution, which preserves that inherent value for all existing shareholders.
So, this leaves us with the ultimate valuation question for this entity. Will the broader market eventually look past those cyclical textile earnings and re-rate the stock from a lower textile multiple to a premium holding company multiple based purely on its prime Mumbai real estate? It really is the central tension of this whole sum of the parts puzzle. As an equity analyst, my job is to present the fundamentals, map out the structural moats, and identify the catalysts, but at the end of the day, the market decides the multiple. You'll definitely want to keep a close eye on those operational margins and the Dadar-Perel infrastructure developments as we progress through FY27.